I'm going to get into the meat of Chapter 9, which deals with depreciation. And again, you guys already know how to record depreciation. You always debit depreciation expense, and you credit accumulated depreciation. So we're definitely not going to waste any time going back to the basics. Now we're going to figure out how to get those numbers. Basically, I'm going to share with you right now 3 alternative methods on how can you calculate depreciation. Okay? And so before we go into those methods, those are certain things that we have to consider, certain factors that you always have to consider with depreciation. Okay? Remember that depreciation is done at the end of the year as an adjusted entry, and depreciation lowers the value of the asset. So, the 3 types of depreciation, depreciation methods that we're going to talk about are going to be straight line, units of production, and double declining. Straight line, units of production, and double declining. And so again, with these methods, guys, we won't be doing a lot of journal entries. We're going to do straight calculations, all right? And so let's start with an example. There are certain things that you have to have in order to depreciate. And so let's suppose that we have a truck. I'm going to put that information over here. Let's suppose that we have a truck. And let's suppose that we just made the purchase of the truck. And so one of the factors you always have to consider is the cost. Let's assume that the cost of our truck, I don't know, is $200,000. Right? Let's assume that we have to have a salvage value / residual value. And basically your salvage / residual value, sometimes people call it salvage value, sometimes people call it residual value. That basically is an estimated amount that you expect the asset to be after it's fully depreciated for its whole life. So for after the entire life of the asset and it's fully depreciated, it still is going to have a value. That value, we consider it to be the salvage value or the residual value. So let's assume that the salvage value for this truck is $40,000. So basically we say throughout the life of this truck, after it's finished depreciated, the value of it, the salvage value of it, should be $40,000. Okay? Now, before we move on, there's a couple of inferences you can make from that, right? Think about it. If we purchased the truck for $200,000, and we know at the end of the truck, life of the truck, is going to be worth $40,000, at least that's what we estimate, right? Then how much are we going to depreciate it for, right? So just looking at that, we could calculate the depreciable cost, right? We can understand the most we're going to depreciate this. The most we're going to depreciate it is the difference between the two, right? $160,000. Okay, so basically we know that by just looking at our salvage value. And then last but not least, you would have another estimate, which would be considered useful life. How long do we expect to use this truck? What's the useful life of the truck? Let's say 5 years. Okay? And so basically, these are the basic factors of depreciation. You have your cost, you have your salvage value, residual value, and you have your useful life, 5 years. Okay, so we're going to use these factors in order to carefully calculate the correct depreciation amount. Okay? And so the first particular method that we're going to use It's called straight line, right? And straight line basically calculates an average. It calculates an average depreciation amount that you're going to lower the asset each year. Remember, depreciation is an expense to the company. And so straight line allows you to calculate a fixed amount of depreciation expense that you're going to apply to this asset every year. The number won't change. That's why they call it a straight line method. Because if you plotted that on a graph and you use the depreciation expense as your y-axis and the number of years of the life on your x-axis, if you plotted every year that you would make that depreciation, it would give you a straight line. Okay? So the formula is very simple. Cost minus salvage value. I'm going to put SV. Salvage value, residual value is always interchangeable. Divided by number of years. So we have cost minus salvage value divided by number of years. That's your straight line, SL, straight line depreciation calculation. Okay? And so we already know that anytime, like I mentioned before, when you take your cost and you subtract it from your salvage value, we call that depreciable cost. That's just basically saying that's the most we're going to depreciate it for. That's the cost that we're going to depreciate it for. All right? And so we could apply depreciation expense for the first year based on using this formula on the straight line. And so we know the cost for the truck is $200,000. The salvage value is $40,000, which gives us a depreciable cost of what is that, $160, as we already said. And the number of years, 5 years. Pretty piece of cake, right? So I'm going to take out my trusty calculator. And I'm going to say 160 divided into 5, $32,000. $32,000 per year. $32,000 per year. Okay? And so that's the answer, guys. $32,000 every year. So under straight line, we're going to depreciate this asset. We're going to debit depreciation expense, credit accumulated depreciation each year for $32,000. Okay? But there's a couple of things I could ask you from just this answer. Okay? And you need to understand. I may be able to ask you, what's the depreciation expense for year one? DE, depreciation expense for year one. What's the depreciation expense for year one? The correct answer is obviously what we just calculated. $32,000 per year. I mean $32,000, right? Because it's per year. I could ask you, what's the depreciation expense for year two? And obviously the correct answer again would be what? $32,000. Again, this is straight line, so every year depreciation expense is going to be the same. But I could also ask you, what's accumulated depreciation? Accumulated depreciation for year two. Okay? Now, remember what accumulated depreciation is. Go back and review the other lectures about that. Accumulated depreciation is a contra account, right? And the key words are right there in the title. Accumulated depreciation. What does accumulate mean? To grow, to gather, to collect, to expand. That's what accumulate means pretty much. And so basically accumulated depreciation is the account that takes all the depreciation expense for the life of the asset and it accumulates it. So each year that you're depreciating the asset, your accumulated depreciation account should do what? Accumulate. It should expand. It should grow. Okay? Now, remember what else happens with this accumulated depreciation. This accumulated depreciation gets larger, but where do we report accumulated depreciation? What financial statement does it go on? It goes on the balance sheet. And we saw that it goes on the balance sheet directly under the asset. The asset stays on the books at cost. It never changes, but the value of the asset is calculated by taking the cost and subtracting that accumulated depreciation. So each year the accumulated depreciation is rising, is actually causing the book value, your formula for book value, is cost minus accumulated depreciation. The book value of the asset is doing what? Going down on the balance sheet. Okay? And so if I ask you what's accumulated depreciation for year 2, accumulated depreciation for year 2 should be the sum of all the depreciation that has been done so far. All of these questions are at the end of the year, right? Because that's when we make the adjustment. So at the end of year 2, accumulated depreciation should be $64,000. Why? Because accumulated depreciation adds up all the depreciation that's been done. Moving forward, I could always also ask you, what is the book value? Book value for year 2. I could ask you, what's the book value for year 2? Now, I've just given you the formula for book value. The formula for book value is always cost minus accumulated depreciation. Cost minus accumulated depreciation will always give you book value. And so cost will never change, but accumulated depreciation will every time you depreciate it at the end of the year, right? And so for me to calculate book value for year 2, I first need to find out accumulated depreciation for year 2, right? And so we've already discovered what accumulated depreciation for year 2 is because we calculated it right before that, $64,000. So in order for me to calculate my book value, I would take the cost of $200,000 and I would subtract the accumulated depreciation of $64,000. Obviously, that would give us, what is that, 136? 136,000. So on the financial statement, the balance sheet, the book value of this asset at the end of year 2 should be 136,000. Okay? And I could ask you that throughout the life of the asset. I could say, what's depreciation expense for year 4? What's book value for year 4? What's accumulated depreciation for year 3? I could ask you several questions about that, and it all comes from this particular transaction, this particular calculation, and knowing how it affects everything, how everything is connected. So make sure before you get into the grooves of this, you go back to your depreciation section from chapter 3 and understand the effects of depreciation. Okay? So this is a straight line.